Joining me now is Charlie Bobrinskoy, Vice Chair of Ariel Investments. Charlie, and just set the scene for us. What exactly has been going on with value stocks lately?
Well, they've been hurt this year because everybody's afraid of a Fed-induced recession. And if a Fed-reduced recession, tech stocks, growth stocks are going to probably outperform. Bond prices actually get bid up as people look for places to hide. That's good for growth stocks, bad for value. So right now, the market, value stocks have been on sale. Growth stocks have been bid up. And that's brought some opportunities for us value managers. Thank you for using my maverick call sign, Value Man. I appreciate that, Kelly. But right now, there are some real opportunities. Everybody's afraid of this market at 19 times earnings. A lot of value stocks are trading at less than 10 times earnings.
So when you see, for instance, the NASDAQ 100 rebalancing, we were talking about this top of the hour, but what does that tell you? Just your sort of sense from watching markets?
That a lot of these tech stocks have gotten wildly overpriced, and they're trying, the people who run these indexes know it, and they're trying to have indexes that aren't just dependent on the Magnificent Seven, on the AI dependent names that have run so much. They are aware, the people who run these indexes are aware of this problem, and they're trying to rebalance so that the indexes aren't just dominated by a few names, but there's just no getting around it. Growth, technology, AI stocks have dominated not just the NASDAQ, but the S&P.
It's crazy, though, because the valuations aren't that, we're not, some of them we are, but other, Microsoft and the rest of them, we're not talking about sky high. We're talking about things that are just a little bit, higher than half of the consumer packaged goods sector.
Well, to you, 25, 26 times PE looks reasonable. To me, that's blood-wateringly high. Look, I do think that's a fair statement. Some of these companies are not the original dot-coms in the year 2000, where there was no real business, where everybody just had a business plan. These are real companies. But we are talking about names that used to be reasonably priced. There was a very short period of time when Apple and Meta were trading in low single-digit teens PE ratios, and now they're all upper 20s. So your point is a good one. This is not crazy, but these stocks are expensive.
So, I want to talk to you about the eyeball in Las Vegas, the Sphere, and because I was thinking about you, and I didn't realize we were that close to opening. Before all of that, though, some of your names are energy picks. We were just doing this whole thing about top states for business and how volatile energy prices are even hurting, some of the business climates down there and all the rest of it. What would you do with the energy stocks in someone's portfolio right now?
They are very cheap. So a name I always talk to you about is Apache, which got down to about 4 times earnings. The energy stocks are trading as if oil is going to $50. And that is possible, but it's not going to happen anytime soon, in my opinion. The best estimate of where oil is going to be next year is where it is today. And today we're at 74. Yes, there's backwardation in the forward curve, and people are predicting lower prices. But the demand for oil is going to be higher the next couple of years than it is today.